Next we have Stephen Wetherall, who's the MD and the CEO of Lucapa Diamond Company.
Thank you, Trish. And thanks again to Bull and the Paydirt media team for putting on another important edition of Africa Down Under. I don't think you can underestimate the importance of standing side by side with your government partners. And for the second year running, we do miss the presence of our Angolan, Lesotho and Botswanan colleagues. I think it's important to stand side by side, shoulder to shoulder, not only to promote the benefits of investment in our projects, but also to assist them in the greater investment within their countries as well. So thanks, Bill. For those of you who don't know the Lucapa story, let me introduce you to Australia's growing global producer of high-value diamonds. Copies of our presentation are available at our booth on our website, as well as on the ASX platform, and I do urge you to read the cautionary statements when you get the opportunity to do so. We're a multi-asset diamond producer focused on developing our next production asset here in Australia. We have already, in conjunction with our local partners, developed two very special assets, the Lulo mine in Angola and the Mothae mine in Lesotho. We have put out our maiden guidance this year, where those two mines, after taking into account the corporate overhead here in Perth, are expected to produce a cash operating margin of between 17 and 21 million Australian dollars. I'm proud to say that after 6 months, we are already at $13.5 million, so we have guided the market towards the upper end. We are a company that's focused on growth, not just organic growth through normal expansion and success in our exploration assets, but also through inorganic acquisitions. And in that regard, we have strategically acquired the Merlin Diamond project here in Australia. It's a 4.4 million carat resource, and when we bring that into production over the next 2 years, it will be Australia's largest producing diamond mine. I mentioned another aspect to growth, and one of those important to us is obviously kimberlite exploration success. And in that regard, we are significantly advanced in one of the most prospective kimberlite exploration programs in Africa, the Lulo joint venture, where we are searching for the primary sources of the very special diamonds that we are mining on the very same ground. Thanks to the strength in our operations over the first 6 months, the strength in the market, as well as the recent raising that we have concluded on the back of the Merlin acquisition, we are in our best financial position ever, and we have some 27.6 million cash and attributable cash on our balance sheet. The market is resurgent. 2019, it was a very tough year in our diamond space. In 2020, the world all but ended. But what a difference a year makes. A year ago, we were struggling to give our diamonds away. Today, we cannot produce enough. The market is strong, and we don't see that changing anytime soon, and I'll take you through some slides on that as well. Unfortunately, the producer equities have not tracked the same resurgence in the rough diamond price particularly, and we see ourselves trading at a significant discount even to the carrying value or the book value of our net assets on our balance sheet. But for all the reasons I've just outlined to you on this slide, we do believe there's a significant re-rating coming for our stock. So continue to watch our story closely. I noted two of those mines that we have developed. They are niche production assets. The Lulo mine in Angola, in which we own 40%, is the highest dollar per carat diamond mine in the world. Our 70% owned Mothae kimberlite operation in Lesotho is the second highest dollar per carat kimberlite mine in the world. This slide is going to get a bit busy, so please do not read it all. I'll outline what you should be looking at. Of the metrics that we guided the market to, the cash operating margin in the Lulo mine is going to be between 28 and 32 million Australian dollars this year. Our attributable portion going to be somewhere between 11 and 13 million dollars. Our mine in Lesotho, again, 11 to 16 million Australian dollars in cash operating margin. Our attributable portion is going to be, why is that not coming up? There we go, 8 to 11 million Australian dollars. As I mentioned to you, after taking into account the corporate overhead here in Australia, we have guided the market to 17 to 21 million Australian dollars for the full financial year. How have those assets performed? I'm not sure why it's not coming up. I think perhaps the presentation is not 16:9, but 3:4. But if you have a look at the operation so far for the first 6 months, 11 million Australian dollars produced in cash operating margin on an attributable basis in Angola. And if you have a look at it in Lesotho, 4.1 produced, already 13.5, as I noted to you on the earlier slide. So operations are performing well. They're in a good market, sending product to market in a strong pricing environment. We are expecting more of the same for the second half of this year. I'm going to spend a bit of time explaining to you why we're lagging and why we do believe that there's a significant re-rating coming. On this slide, I'm not being selfish and only promoting us. I am going to list a few other diamond producers who are suffering the same consequence, but I don't think that's going to last for too much longer. On that slide, the black graph there represents the global rough diamond price since the beginning of January 2019 to where we are today. Unfortunately, when the pandemic arrived in February 2020, it all but shut down our industry, and diamond prices did fall off a cliff. But where we are today, diamond prices have come back very strongly, thanks to a lot of people that spent time buying products as opposed to traveling, but also when the economies opened up because of the depletion of those polished inventories, prices were resurgent. So we are 20% ahead today where we were back in January 2019. And those diamond prices are the highest they have been since 2014, so a 7-year high. If you map the producer equities against that graph, yes, when the market softened in 2019, you saw all the producer equities share prices soften as well. And when the pandemic hit, we all fell off a cliff. But if you look at what has happened since, the only diamond company, producing company that tracked the return of the rough diamond price was the largest listed major in Alrosa. Everybody else has basically just tracked along the bottom. And so for us, therein lies the opportunity. I think the sheer size of what is being produced, not just by ourselves, but by the other producer equities, when we show continued cash generation from our operations, that gap is going to narrow very, very quickly. Is it a short-term epiphany? Is it a short-term rise in diamond prices? We certainly don't think so. We know that rough production is 30% below its highs of 2005-06, when 177 million carats came to the market. Where we stand today and over the next 5 years, it is just going to be around about 128 million carats on average. There are no big mines coming into production that is going to change that. So when you look at the work that Bain & Company, who I'm sure most of you in this room know, have done, they do an annual report on the diamond industry and show what they predict as the supply-demand fundamentals for our industry. So that first graph that you see there, or line, is the diamond supply in US dollar terms over the period to 2020. As you can see, we are at our lowest ebb in 20 years. What's going to happen going forward? They have predicted that rough diamond supply is going to grow at only 1% on a compound annual growth rate. When you map that against the demand on a low demand basis, which they expect to grow at 4% compounded annually, there is a big gap that is developing. When you have a look at their optimistic demand scenario, which they expect to grow at a 6% compounded annual growth rate, that gets even larger. If you have a look at an optimistic supply scenario, that really just tracks the low ebb in the demand. But as I mentioned to you, there are no carats outside of the ones that we know about coming to the market over the next 5 to 10 years. So the only thing that can really fill that gap is going to be a support in the price and a rising price. So over the next 10 years, we look forward to bringing more production from our 2 fantastic mines into the market, but we also look forward to bringing into production our new asset here in Australia, which is the Merlin Diamond project. In the Northern Territory here in Australia, there is a mining tenement. Surrounding that mining tenement is an exploration license called the Orbit Tenement. On that ground, Ashton Rio Tinto discovered a number of kimberlites. They have discovered 11 kimberlites. There are more dots on that map because some of those are blows as well. Majority of them have been on the mining lease. Contained in those kimberlite pipes is a resource of 4.4 million carats, 2.2 of which are in the indicated category. In addition, on this ground, there are some 70 unresolved geophysical anomalies that we want to go and test because we do believe there is significant exploration potential on this ground. In addition, there is a large magnetic anomaly, which we want to go and have a look at. I don't believe, or we don't believe that is a kimberlite pipe, but we do want to go and test it. And just to give you some neurology, that is 40 kilometers south of the MacArthur River lead zinc mine as well. So when you see that project with this opportunity available in Australia, would you go and have a look at it? And the obvious answer is yes. So we signed binding agreements to acquire 100% of this ground. As I mentioned to you, a lot of those kimberlites were discovered by Ashton and Rio Tinto and operated for 4 years, extracting some 500,000 carats from those kimberlites. They sold the diamonds for, on average, around about $103 per carat. Where the diamond price index has gone today since 2003, we are looking at a 3-fold increase in diamond price. However, I've put that diamond on the slide just to outline to you what we expect from the large stone contingent that is going to come out of this operation. That diamond there is the 104 carat diamond recovered from the Gareth pipe. It is the largest diamond ever recovered in Australia. At the time of recovery, it was valued at $500,000 a carat. Sorry, not per carat, $500,000 in total money. I wish per carat. That today is worth $3 to $4 million. So you are looking at a 6 to 8 times uplift as opposed to just a 3-fold uplift on the global rough diamond price index. And therein lies a lot of opportunity for us as a large stone producer where we have integrated through the pipeline and we are also cutting and polishing our diamonds. I mentioned the resource again of 4.4 million carats because it's significant and strategic to us as a company. It grows our attributable resource carats 500%. So we are going to be operating for many, many decades to come. It was in a liquidation process, so therefore generally you are going to pick it up at a lower end cost. We offered 8.5 million Australian dollars for this project, which was accepted at $2 per resource carat. Now, to draw a comparison to other operations in our stable, we acquired the Mothae mine in Lesotho for 12 Australian dollars per resource carat. So we did really pick up a great asset here for a low end cost. Multiple development opportunities. We all know that the earth is a great vault and store of diamonds, but can you develop a mining extraction methodology and processing that's going to deliver value to us as a company and to our shareholders? And the answer is yes. We see near-term, medium-term, and long-term developments. On the bottom right-hand side there, you see an open-pit conventional extraction methodology, and you see open-pit vertical mining, which is almost like a shaft system, and we do see developments beyond that in 2 of the clusters for underground. On top of that, I've outlined the 70 anomalies already. We see significant potential in extending that resource as well. So when we bring it into operation over the next 24 months, it will be our 3rd producing asset, and we do believe it's going to be Australia's largest. We're currently conducting our scoping studies on all 3 methodologies, and we do look forward to bringing those to the market over the next couple of months as well. We are the operators of a very, very significant exploration asset in Angola, probably the most exciting ground in our space. And I can say that because we are recovering large, high-value diamonds very frequently. On the top right-hand side there, you see the frequency or the rate at which we recover those. Unlike a lot of other mines or other grounds, that would be an intermittent, sporadic, or ad hoc graph. Look at the concentration at which we are recovering them. They're large, brittle-shaped. They don't have any rounded edges. Those are all proximity indicators to where we are looking for the source. So if you look underneath you, then look at the map on the left-hand side. We have a significant number of anomalies underneath us. We have to methodically work through them. We have done that over the last 4 to 5 years. We have drilled 120 targets, discovered 107 kimberlites. We've sent 81 of the drill core away for mineral chemistry analysis in Canada, and we've identified the 18 high priority targets, the yellow dots, if you can see them on that map, which we are now currently bulk sampling. We started at the wide end of the funnel. We are now at the narrow end of the funnel, extracting that ground, and we're going to start putting those through the plant as well. We've just recently ordered a kimberlite bulk sampling plant, standalone crushing circuits fleet. We are going to be putting that dirt through at a rate of knots, and we hope to find what we've been looking for fairly soon. We do have 2 other projects, earlier stage projects here in Australia in Brooking, and in Botswana, the Arapa project. Please come and visit us at our booth. My time is running out, and we'd love to take you through what we are doing there, because they too are very prospective assets. So I'm going to, or not, to producing high-value mines, generating good cash flows as we have guided the market to. We have got exceptional development value that's going to come to the fore over the next 24 months, and we'll bring those scoping studies to you over the next couple of months as well. The most significant exploration ground in our space, and we are adding to that with our Merlin opportunity, and those programs are well funded. If you have a look at the diamond market thematics that are outlined over 2 slides previously, our space has never been in a better position, well balanced, and probably in its best position for the latter 2 or the last 2 decades. We're extremely well funded, as I mentioned earlier. We're going to run hard at all of our projects, and because we're able to do that, we should be, extracting the value that we know are there. So please do take the time, come and see us. Let's explain to you how we've integrated through the diamond pipeline, how we have taken our projects from exploration, evaluation stages through development, through mining, and then starting to extract additional value from beyond the mine gate as well, and how we're doing that on our Merlin project and what we've got in store for our future at Lulo, Brooking, and Arapa as well. So thank you very much.